In this video, we're going to explain the concept of expiration and shed light on the difference between exercising and closing an option, helping you make informed decisions about when to choose each path. Now, in traditional stock trading, buying shares in a company doesn't come with an expiration date. You can usually hold those shares indefinitely, unless the company goes private or is delisted. However, options trading is different. Each option contract, whether a call or a put, comes with an expiration date that is determined at the creation of the contract itself. An option's expiration date is the last day you can exercise your right to buy or sell the underlying stock at the agreed upon strike price. But remember, you can also exercise your right any day up to or on the expiration date, which is called early exercise. After the expiration date, the option contract becomes null and void and has zero value. So, when do option contracts typically expire? Well, the standard expiration cycle is 1 month long, typically concluding on the third Friday of each month. The exception to this rule is if the third Friday happens to be a market holiday. Then the expiration is moved up 1 trading day. Beyond the standard monthly expiration, there are also non-standard daily expiration cycles, weekly expiration cycles, and quarterly expiration cycles, which conclude on the last trading day of March, June, September, and December. Additionally, there are certain indices, such as the SPX, that have unique expiration schedules, but we can save that for another time. For now, the key takeaway is that the most common expiration dates fall between the 15th and 20th of each month. So, before diving deeper, let's get acquainted with 2 critical terms: in the money and out of the money. If it would be profitable to exercise an option contract, we call it in the money. Conversely, if it would not be profitable to exercise an option contract, we call it out of the money. These terms typically do not take into consideration the cost or credit of buying or selling the options. It's purely based on the underlying asset's price and your contract's strike price. But what do we mean by exercising? Well, exercising essentially means executing the right given by the option contract to you as a contract's owner to buy or sell the underlying stock at the strike price. You can choose to exercise an option contract at any time before expiration. Alternatively, if you don't take action, your option contract will be automatically exercised at expiration if it is at least 1 penny in the money, a process referred to as the exercise by exception by the Options Clearing Corporation. For instance, if the strike price for a call option is $50 and the stock closes at $50.01, your option will be exercised. Now, at this point, it's important to note that exercising an option contract requires either capital to buy the underlying shares at the strike price or shares that you own to deliver for the strike price. In other words, if you're exercising a call option that involves buying $10,000 worth of stock, you'll need $10,000 in your buying power to complete the trade, even if you plan to immediately sell the stock. For a put option, you would need to own the shares that you are obliged to deliver, or else you would wind up short of all these shares and be in a precarious situation, forced to buy them back at a future price. People who find themselves in these situations often get faced with margin calls and have to make their positions flat, in other words, not negative, as soon as possible by raising capital or buying back shares. While managing your options positions, including taking proactive steps to mitigate any risk, is ultimately your responsibility, it's crucial to note that on the day of expiration, public investing may need to intervene to reduce risk. As of 3 p.m. Central on the day of expiration, if your option is in the money and you lack the buying power or the requisite underlying shares to exercise your contract, we will endeavor to sell the contracts on your behalf. This is why many options traders avoid exercising option contracts altogether. Instead, they choose to sell the option contract itself before expiration. Then they can realize the profits from the increase in the option's value from both the intrinsic value and time value without the need for additional capital or the worry about being short cash or shares. Closing a position is when an investor takes the opposite action of an open position, selling a long position or buying back a short position. One of the additional benefits is that it can help you capture both the intrinsic and extrinsic value of the option if you are short the option, and can reduce the time decay if you are long the position relative to holding until expiration. Extrinsic value, also known as time value, is lost when the option is exercised. Let's take a closer look with an example. Imagine you bought a call option for a company called FlyFit at a strike price of $50 when the stock was trading at $45. You paid a premium of $2 for the contract, which with the option multiplier equals $200. Now, let's fast forward a few weeks and say that FlyFit's stock price has soared to $60. Your call option has 10 days until expiration and is trading at $11. That means the intrinsic value of your option is $10, which is the difference between the current stock price of $60 and your strike price of $50. And thus, the remaining $1 is time value. You may decide that you do not want to wait any longer and would like to exercise your option or sell the contract. Let's look at each action's benefits and risks. If you decide to exercise your option, you have the right to buy 100 shares of FlyFit at $50 per share, costing you $5,000. Theoretically, you could then sell those shares at the current market price of $60 per share, netting you $6,000. Your profit in this scenario would be $1,000 minus the original premium cost of $200, totaling a net profit of $800. Of course, the stock price could be volatile and the price can increase or decrease should you decide to hold the stock for a period of time before selling. Volatility may result in an additional gain or an additional loss on the stock holding itself. Conversely, instead of exercising the option, you could sell the option contract itself in the market where it's trading at $11, or $1,100 total. Subtracting the initial premium cost of $200, your net profit would be $900. Selling the option contract also involves less capital outlay compared to exercising the option, which requires you to pay the strike price for each share. In this scenario, selling the option contract is more profitable by $100 due to the remaining time value, illustrating the potential benefit of selling the option contract rather than exercising it early. By selling and locking in your profit, you limit the time decay in the option's price that would have otherwise occurred. With that said, it's important to note that there is a potential risk for the stock price to go up further and you losing out on the potential gains should you sell. Always remember, the decision is in your hands whether to close your contract position before expiration, potentially benefiting from both intrinsic and time value, or to exercise your contract and sell or hold the stock. The choice between selling or exercising an option also depends on one's market outlook, financial situation, and risk tolerance, among other factors. A well-informed decision between selling or exercising an option can significantly impact the profitability of an options trading strategy and may help you avoid a margin call.